Welcome to Alpha Insights. I'm Dakota. Today we're unpacking a choppy day in big tech. NVIDIA slipped and saw heavy trading. With me is Josh, our market historian who helps turn market noise into useful perspective. Remember, if you have questions as we go, you can ask us at stockalpha.ai.
Thanks, Dakota. Glad to be here.
Josh, quick headline first. What actually happened with NVIDIA today?
NVIDIA dropped about 3.5% and ended the session around $174.19. What stood out was the volume, roughly 202.86 million shares traded. So it wasn't just a small move, it was a big move with big participation.
Heavy volume. That sounds important. Walk me through why the volume matters for everyday investors.
Volume tells you how many people changed their minds, or at least tried to change hands, at those prices. When you see a sizable price move on heavy volume, it usually means conviction, either sellers pushing out holders or buyers stepping in aggressively. For investors, heavy volume can widen intraday spreads, so if you want to trade a large block, your execution costs can go up. It also increases short-term volatility, so the stock can swing around more than usual over the next session or two.
If I'm already holding NVIDIA, what should I actually do? Panic? Hold? Sell?
First thing, don't panic. A one-day drop of about 3.5% is significant, but not catastrophic for long-term portfolios. Ask yourself 3 questions. What was your original reason for owning it? What's your time horizon, and how much of your portfolio is in the position? If NVIDIA still fits your long-term thesis, today might be a chance to reassess sizing rather than sell automatically. For those who need to reduce exposure, consider scaling out in pieces or using limit orders so you don't get worse fills in a fast market. If you're worried about further downside and want protection, options like a put or a collar can hedge. But remember, that's cost and complexity. It's not a free fix.
Good practical advice. Now, traders love volatility. What does this look like from a trading perspective?
For active traders, higher volume and bigger intraday moves create opportunities. You can play momentum if price keeps trending on follow-through volume, or mean reversion if it spikes and shows exhaustion. The key is to watch intraday price action and volume patterns. Are buyers stepping in at support levels, or is selling accelerating on each bounce? Tight stops and position sizing are vital here, because big names like NVIDIA can reverse quickly. And always plan your exit before you enter.
You mentioned execution risk earlier. For listeners with larger orders, what are best practices so they don't get burned on fills?
If you have a large order, don't try to shove it through at market when volatility is up. Use limit orders, work orders in pieces across the day, or ask your broker about algorithmic execution like VWAP or TWAP to minimize market impact. Some platforms also let you route bigger trades to block trading desks or dark pools, but those come with their own trade-offs. The core idea is to avoid moving the market against yourself.
Josh, give me a little history. Do we often see these kinds of single-day moves in big chip makers?
Yes, especially for companies tied to hot themes like artificial intelligence, they can swing more because investor expectations are stretched. Historically, a heavy volume down day can mark either a pause in a longer uptrend or the start of a bigger correction. Context matters. Look at the next few sessions. If volume dries up and price recovers, it may have been a shakeout. If selling continues on high volume, you could be looking at a trend change. That's why monitoring follow-through and the news flow, earnings, guidance, industry data is crucial.
So to wrap this up, for listeners tuning in right after the close, what should they watch first tomorrow?
Watch the opening range, compare volume to today's heavy level, and look for any fresh company announcements. For holders, reassess position size and time horizon. For traders, watch for clear volume-backed moves before taking a directional trade. And for anyone placing larger orders, use limit orders or execution algorithms to manage impact.
Great, let's finish with 3 quick takeaways.
1. A drop of about 3.5% on heavy volume is notable, but not necessarily game over for long-term investors. 2. Heavy volume increases execution risk and short-term volatility. Use limit orders and consider scaling. 3. Traders can find opportunity in the volatility, but only with strict risk management and attention to follow-through volume.
If you have questions about anything we discussed today, you can ask us directly at stockalpha.ai. We answer listener questions live. And for more market insights and our research, head over to stockalpha.ai. Thanks for listening, and Josh, thanks for the perspective.
Thanks, Dakota. Talk soon.